If it's heads, you double your investment. If it's tails, you lose everything. That's the essence of a binary option. Many unscrupulous people are packaging these as investments, but it's not an investment, it's gambling. So if you want to understand what a binary option is, or what options are in general, then watch this video. Why do we think binary options are gambling, not investment? Okay, if you've been trading options for years, it would make sense to play around with binary options. But for someone who's new to investment, it really is like juggling chainsaws. And thanks to a regulatory loophole, companies that are selling binary options to unsophisticated investors are able to operate within the EU and don't need a license from the FCA or from the Gambling Commission. To understand why this is gambling and not investment, let's step back and see what an option actually is. As its name suggests, it's an option, but not an obligation, to buy something or sell something, that would be a call option or a put option, for a fixed amount, that would be the notional amount, at a fixed price, which is the strike, at a fixed time in the future, that's the expiry. Although that seems like a fairly simple setup, the consequences can get a little bit hairy. But you don't need all of that maths to understand the essence of an option. This is really all you need to know. The case you're probably familiar with is the one on the left where you just buy a stock. You buy it because you think the price is going to go up, and your profit goes up 1 for 1 and down 1 for 1 as the share price moves up and down. The upside on an equity is unlimited, and the downside is that you could lose your whole investment. But the key thing here is the payoff is linear. If the share price goes up 1%, the value of your investment goes up 1%. If the share price goes down 1%, you'll lose 1% on your investment. But what if you don't want the downside? What if you just want to buy the upside of the stock at some point in the future? In that case, you can buy a call option. So let's say the stock's trading at £100 today, and in 1 month's time you think it's going to go up. You can buy a call option to buy the stock at £100. If in 1 month's time the stock price is below £100, you don't exercise your call option. Remember, it's a right to buy, not an obligation to buy at £100. So if the price falls to £99, you just won't exercise the call option and you'll lose what you paid for the call option up front. But if the share price is 110, well, you would exercise the call option. You can buy it at 100 and you can sell it instantly for 110, and that way you make a healthy profit. This is really neat because all of your losses are paid up front. The most you can lose is the price of the option, and usually that's a tiny fraction of buying the stock. That's the beauty of an asymmetric payoff. But the aspect of it which is tricky to understand, particularly for people who are new to investment, is leverage. I've shown here two scenarios, one in which the share price moves up by 30% and one in which it moves down. If we buy the share, we'd either make a 30% gain or a 30% loss. We pay £100 up front and we'd either pocket £130 or £70 after that 1 year's passed. On the bottom you can see the cash flows, but this time it's if we buy a call option. The price we pay up front is just a fraction of the £100. Here I've shown it as £20. Now when the share price moves up by 30%, we have an option to buy at 100. Do we do that? Well, yes. We buy for 100, we sell in the market for 130, and we pocket that £30. But here's the beauty. We only paid £20 up front. So instead of a 30% return, our return is boosted to 50%. So that's the good side of leverage. Here's the ugly side. If the price had moved down by 30%, well, we certainly wouldn't exercise our option in that case. Why pay £100 for the stock if we can buy it in the market for 70? So the £20 we pay for the option would expire worthless. Our return in this case would have been a loss of 100%. And the probability of that loss is fairly high. It would have been about 50%. If you compare the returns in those two scenarios, for the share, we'd have gained 30%, for the option, we'd have gained 50%, and in the down scenario, the share would have lost us 30%, and the option would have lost us 100%. And that's what leverage does. It amplifies our gains and our losses. If you're investing your life savings, leverage should be used with a great deal of caution. So what's a digital call option? Instead of the hockey stick payoff that we saw before, the payoff is now a step function, which means that if the stock price moves above 100, we get the full payoff, but no more. Our upside is no longer unlimited, it's now limited by the binary call option. The downside is just the same. If the stock price is below 100 at expiry, we lose everything. This is much more akin to the coin toss example which I used in the introduction. Usually these binary options are very short term and they carry leverage, which to me is pretty close to the definition of gambling. So is the regulator asleep? Fortunately not, but as they say on their website, they don't regulate binary options. If a firm is located in the UK and they deal in binary options, they need to be regulated by the Gambling Commission. And there are many worrying reports about consumers being scammed by fraudsters who claim to be selling binary options. So if you are going to trade these, and I wouldn't unless you understand options, if it's based in the UK, check that they're regulated by the Gambling Commission. If it's in an EEA member state, check whether they're authorised to deal in binary options, or alternatively, that they're authorised to deal these options in their home country. Don't go for fly-by-night companies which are not regulated. And always follow the very simple guideline. Don't invest in things you don't understand. If you've lost money with binary options, please contact us. Do you agree with us that it's gambling, not investing? You can tweet us at PensionCraft or contact us on Facebook. To see more of our videos, look at our website.